Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back. This is actually the weekend video update. I'm recording this on Sunday evening for Friday's trades. And we did have a pretty active day, and not only did we have just a lot of trades that were going through, both opening and closing orders, but we had a lot of different types of strategies and an exercise, basically synthetic exercise of our BX position that we got assigned on Thursday. On Wednesday, I believe. So I want to go over all of those tonight, and some of these are combo orders, so I want to kind of go through those in a good order so that you guys can follow along. And I'm going to start with actually the vertical spread in Pandora, because this actually opening trade, which is a hedge, actually kind of goes with this closing trade, which we have down here, which is our first closing trade that's listed. So here's what happened. We had a basically iron condor on in Pandora, and Pandora's earnings were not good, and the stock fell, right? And the stock fell pretty hard. So what we did is, and what we usually do when this happens, if we have an iron condor on and we get really, really tested on one side, is that we close out the side that's not being tested by the market. So in this case, the stock fell. So we actually closed out the top side of our trade and rolled that position closer to the market to take in extra premium and credit. So you'll notice that we have down here in the closing alert that we closed out our 31.30 call spread for a 6-cent debit. So we took $24 in profit there, and then went ahead and sold, so resold the same number of contracts, so 4 and 4, keeping this vertical spread very, very tight, the same number of contracts. We don't take in any additional risk, just extra premium, which is really important here, so no additional margin by getting closer to the market. But we went ahead and sold the 27.28 call spread for a 20-cent credit. Now, you could have gotten a little bit closer. 26.27 call spread was trading around 23 cents, but we just want to give ourselves a little bit of a window of opportunity to make some money if Pandora does happen to rise between now and expiration, right? And that would be the hope, is that we get some sort of bounce off of this earnings low that we've had, and Pandora rises and kind of trades in between our strike prices. So again, just to recap before we get to the Analyze tab, what we did is we rolled down the call side. So we bought back the 30.31 call spread for a 6-cent debit, and then we resold the 27.28 call spread for a 20-cent debit. So net of the credit and debit, we took in about 14 cents of net additional credit on the roll down between what we paid on the exit and what we paid for the new entry. So if we just go to the chart real quick of Pandora, you can see exactly what happened, right? Stock just gapped lower. And so our 30.31 call spread, which was kind of right on the doorstep, now is not really worth anything, right? It's practically worthless. Now, we do have some time between now and expiration, so we could have held that all the way, but for another 6 cents, it's just not worth it to hold it. So without it adding any additional risk, we just went ahead and got a little bit closer to the market, and as implied volatility falls, that will obviously be really helpful for this position. So we currently have a 26.25 call spread, so you'll notice that Pandora is in the money on the downside. But by rolling down our topside trade, we now have this 27.28 call spread. I'm sorry, we have the 26.25 put spread. We now have the 27.28 call spread, and we now have a very narrow iron condor. So our kind of window of opportunity here is really between about 25 and 27.5. That's really what we're looking for, and really not out of the question. Pandora can easily bounce back up in this range. It's only about $1.50 move for this stock that was down a pretty good amount on Friday. So that's what we're looking for. We're looking for a move back inside this range. And if Pandora continues to move lower, we've actually given ourselves room to actually turn this into a butterfly spread. So we could move down this topside call spread and resell a 26.27 call spread and take in even more credit and premium. So the whole idea here is that we just continue to take in premium and credit while not increasing our risk by widening out our strikes or selling more of the actual option. And this overall is going to do one of two things. It's either going to allow us an opportunity to make a profit, or at the very least reduce our maximum potential loss. And so what a lot of people do in this situation is they just kind of leave the position on, or they close it out, and they don't really work to reduce the loss. So they end up with a $400 or $500 loss when they can actually do some rolling and some hedging and actually turn that $500 or $400 loss into maybe like a $100 or $200 loss. Now, if you could do this on 10 trades all year, you understand the benefit in doing this and having this strategy in kind of your back pocket. So that's the idea of showing this to you guys tonight, so you guys can see what we're doing. As we always show you guys, we show you every trade that we have, good, bad, or indifferent, and this really, really helps going forward to understand how to adjust trades that have gone really far against you at earnings. To continue on with some of the opening trades that we had two new opening trades that weren't really related to any other trades, and that was FXI. We went ahead and bought a call spread, the 33.35 call spread. Paid a little bit over mid price for that one. We like to pay around $1, which is half the width of the strikes for this call spread. But really the whole idea with FXI was that implied volatility is very, very low for this ETF, and we think that we're just wanted some additional long exposure in the market. So you'll see that we added the 33.35, and that gave us actually a mid price right above 34. So we actually have some room between ourselves and the market already adding this position and just the way that the options were priced. So this is kind of our line in the sand for the next 2 months, is around 34.14 or so. And you'll notice that implied volatility is still very, very low. So this actually has an opportunity to make a profit if implied volatility expands, because we already have the security right where we want it, kind of in the money. If it just traded all the way to expiration and stayed right here, we'd actually make money. So if it does go higher though, that's really what we want. And we wanted some long exposure in our portfolio, and this kind of gave us that opportunity. Now, the other trade that we went into today is on Friday. So we went ahead and sold a put spread in IWM and got some really good pricing. Now, with the market selling off kind of at the end of the day, that gave us an opportunity to sell a $2 wide put spread in IWM. Kind of going back to the well here. We've done a really good job trading IWM all year and kind of going right back to it. It's very liquid, highly traded, so it's really, really easy to get in and out of. And in this case, we sold a 108, 106 put spread for about a 50-cent credit. So it's actually a fairly good credit for this type of spread. Sold 4 of those, so it's a fairly decent sized position. But you'll see with IWM that we've got a good bit of margin between ourselves and the market again. And let me just actually back this up just a little bit so you guys can see where we're at. Okay, so here's IWM, and you can see that it's sold off at the end of the day. This obviously was really helpful for implied volatility, which went back above the 50th percentile. But you'll notice that our first strike is at 108. So this is kind of where we consider the line in the sand as we go forward, right? We don't want the market to go anywhere below this at expiration. Now, it can trade below there between now and expiration, but at expiration, we want IWM to be above 108. So you see we given ourselves a pretty heavy margin of error. And notice that down below here at 109 and really at 108 before in the past, the market has kind of bounced off of these levels before. So really, we're kind of setting ourselves up for a position right at a good level of support going forward. So if you're a technical analyst and you really look at these support and resistance levels, this is a good area to place a trade, because we do have future or prior support that's going to be acting as support, hopefully going forward in the future. Now, I think that the market is just, if anything, come back down just a little bit and continue to rally up. And that's obviously where we want it to go, at least for this position. But if it doesn't, we've given ourselves a lot of room to be wrong and still be right at the end of June for expiration. So I think that was a really, really good trade. I'm really happy about the pricing in that trade, and I think it'll turn out very well. Now, moving on to some of the other closing trades. So we already talked about Pandora. Another one that we bought back, just had really good move, was Starbucks. So we had originally sold the 67.5, 65 put spread. Bought that back today for a 20-cent debit, which is just really great for May, and took in a $37 profit on each side of the market. So with Starbucks, it was really just a matter of the stock moving up after earnings, which really helped decay the value of the options and the premium. Amazon is one that actually moved really far against us, and we just closed this trade out very early for May. It doesn't seem like one that's going to actually turn back around, and I just wanted to kind of savor the $56 credit and not let that go. Usually I like to hold all these all the way to expiration, because you don't really know what's going to happen between now and expiration. But as bad as Amazon's really earnings and guidance was, I don't think the stock will actually turn around. So we actually were holding on to a 345, 355 call spread. And so on this trade, we actually lost 464, which is a fairly decent sized loss for this type of trade. But at the end of the day, we had added that long exposure, and we've made some money on some other trades. So it really just seemed fitting just to close it out and move on. We don't really need the position in our portfolio anymore. And you can see as I go to the chart of Amazon that it had a pretty heavy drop. So it'd have to recover basically all of this ground between now and then some. So all of this ground and then some between now and expiration. I really just don't see that happening as bad as earnings and guidance was. I think the stock is going to continue to move lower. So at that point, it's just best just to close it out, savor whatever credit you can get out of it, and use that credit into the next trade. The other trade that we closed out on Friday is the Iron Condor in Microsoft. So this is an example, unlike Pandora, which we've had to start adjusting now and actually may turn out to be a profit. But this is a good example of an iron condor that we placed in Microsoft had earnings, which actually placed the stock right in the middle of this condor. So both sides really expired or continued to move very, very low. And I think each side was right around 10 cents or so in credit, and it's about as low as it's going to go between now and expiration. So we went ahead and bought back this iron condor that we had originally put on in Microsoft. It was the 42.44 call side and the 37.35 put side. We bought it all back for a 20-cent debit, and so we took in a nice $38 profit on each condor that we sold. So again, a very small position, but a very good position as far as potential and profit. We've only had this thing for a couple days. You'll notice that even after earnings, implied volatility dropped, which is good. That obviously helped our position, but the stock has stayed very stagnant. And usually one that actually moves quite substantially after earnings, at least a couple days afterwards. We actually saw just pretty much a no move in this stock right after earnings. Now, we could have held this thing all the way to expiration, but again, each side's trading for around 10 cents, so you're really not going to get that full potential until after we get most of the way through the rest of the month and practically into expiration week to see the thing actually start to decay around 5 cents or so. So for 20 cents, it's not worth holding the position. We've made the bulk of our profit in this trade. It's best just to close out the trade and move on to the next one. Okay, the trade that I've gotten a ton of emails about and actually ended up working out really, really well. And we've done a couple videos on this exercise of one of our legs in BX, which is Blackstone. So for those of you who haven't watched the video before, I definitely encourage you to go back here and check it out because we talked about a lot in the prior videos, at least the last two nights. And what happened is that we actually had a 30-31 call spread that we were short. So we sold that 30-31 call spread, and our 30 strike, along with a lot of other people, not everyone, got exercised. So we were actually short stock at 30. So at a $30 price, and the stock was trading above 30. But we still had this long call. So we synthetically had a single long put in BX. When you actually combine the short stock with the long call, we actually had what looked like a synthetic long put in Blackstone. So although the stock, obviously we wanted it to go down, it was really, really tough to make any money unless the stock actually had a pretty good drop. And you'll notice that what we wanted to do on this day here, which was Thursday when we talked about it, is that since we were long the stock or had a long put basically in the stock synthetically, we still had a negative bias towards the stock. And you'll see that we just held it an extra day and the stock continued to move lower, is down almost 3% the next day. That all worked beautifully for our position. So that helped minimize the loss, and what actually turned out to be a very, very good working trade just to wait one day and kind of close it out by making a combo order instead of exercising the other leg, ended up taking the loss down from around $500 to a $125 loss. So a huge win in my column. Even though we actually lost money on the trade just because of where the stock moved, we were actually looking at about a $500 loss when we got exercised. And just by being a little calm and nimble and understanding what position we actually had on, we were able to reduce that loss down to $125. So again, to me, that's a win in my column. If I could do that on 100 trades throughout the year, that's really, really helpful. That's just as good as making a good profit, is reducing a loss on trades. And I think that's what separates a lot of traders from the beginners is reducing that loss factor. So the actual combo trade that we actually entered out of, we did not exercise our call option. We sent out two separate alerts because they are two separate orders. The first one was that we sold our 5 May 31 calls, and we sold those for a $90 credit. So we actually sold those for a pretty good credit that was left in them. If we had kept them all the way to expiration and the stock never got to 31, those would actually be worth nothing. So considering we had 5 of those, we sold those out at a $90 credit. Now, at the same time, we were also short 500 shares of stock. So that call option was helping protect those 500 shares of stock as far as margin is required. So what we had to do is go back in there and buy back the 500 shares of BX stock, and we actually bought them back at $31.20. So what I consider a fairly decent price. So where we lost on the call options or on the short exercise options with the shares and factoring in all the credits and everything, we actually ended up with about $125 loss after all the commissions and everything. I just kind of threw in everything there. So it actually ended up being a little bit less if you don't include commissions, whatever the case is. But at the end of the day, what actually turned out to be a very, very good trade, and I'm glad that we kind of waited. Some of you might have even kept this position and can continue to wait and hold it all the way through expiration if you so choose. You're still short the stock, you're still long the call. You basically have a synthetic long put option at 31. So you obviously want the stock to, or I'm sorry, at 30. So you obviously want the stock to just continue to move lower and lower and lower. You really want this thing to move lower. But every day that you get closer to expiration, the value of those long calls that you're holding that we sold back for a $90 credit is going to be worth less and less and less and less. So really, time is of the essence when something happens like this, where one leg gets assigned. You obviously want to make some quick decisions and only hold it for a couple days or two. Try to kind of adjust the strategy and try to minimize the losses, or at very best, actually get a gain out of the position overall. So I hope that was really helpful to go through these. Like I said, we had a lot of activity this week, and especially on Friday, a lot of opening orders, a lot of closing orders with different strategies and different tactics. So I hope these videos are always helpful. If you have any questions at all, please ask them in the comment section below. I'll get back to all of those tonight or tomorrow before the open, and happy trading.